Welcome to ACCA Masters. Our today's topic is employee benefit, which is one of the important standards in the SBR syllabus. So let's start it with objectives. Its objectives are to prescribe the accounting and disclosures for various kinds of employee benefit. IAS 19 employee benefit further classify the employee benefit into 4 categories. These are said to be short-term benefit, post-employment benefit, termination benefit, and other long-term benefit. Remember that settlement made to past and present employees both are included in the employee benefits. Also, benefit given to employees' spouse, children, or others in exchange of services that are provided by the employees would also be considered as employee benefit. Now it is about short-term benefits. These are wages and salaries, profit sharing and bonuses, non-monetary benefits like medical care, housing, cars facility, and other free services are said to be non-monetary benefits, and paid annual leaves. The short-term paid absentees are further classified into accumulated and non-accumulated paid absentees. The accumulated paid absentees can be carried forward to be used in future period if current period entitlement is not used. For example, if you have not used leaves in the current period, you can carry forward such leaves to be used in future. In such a case, the expected cost of unused entitlement is recognized as accruals. While in case of non-accumulated paid absentees, these cannot be carried forward. Examples are maternity leaves. So they are recognized when absentees occurs. Now about short-term benefits, other short-term benefits which are said to be profit sharing and bonuses. These are recognized if entity has present obligation, remember as a result of past event, whether such obligation is legal or constructive, and also the reliable estimate can be made. So these are recognized if two conditions satisfied, if it is a present obligation and if reliable estimate can be made. In case of present obligation, it could be legal or constructive, and this present obligation should be result of past event. Now about post-employment benefits. These are payable after the completion of employment. So these are payable after the completion of employment. For example, pension plan. Pension plan is held in the form of trust. This trust is generally separate from employer. The sponsor employer and pension plan or scheme are separate entities. Now how it works? The employer pays contribution to pension plan. Employers pay contribution to pension plan, and the pension plan pays in accordance with rules of the pension scheme and in future to the pensioners. Employer pays contribution to pension plan and pension plan pays in future in accordance with rules of pension scheme pension to the pensioners. Remember that amount is held in the form of investment, and return on investment is used to pay pension obligation. Now about types of pension plan. There are 2 types of pension plan: defined contribution plan and defined benefit plan. First, about defined contribution plan. Under this plan, entity pays fixed contribution in a separate entity. So under this plan, the entity pays fixed contribution to separate entity. The obligation of the company is fixed. There is no further obligation. neither legal obligation nor constructive obligation. So obligation is fixed, like annual contribution is said to be 10% of salary or 5% of salary. Now the risk factor is for the employee. What if the future pension is less than the expected? It is a risk for employee, because future pension depend upon the value of funds. There is neither any obligation for the company to contribute any amount further. In case of measurement, normally it is measured as undiscounted, but may be discounted if the contribution is payable after 12 months. Now about accounting for defined contribution plan. In the statement of profit and loss, the annual contribution is recorded or charged to profit and loss account. Charged to profit and loss account. While in case of statement of financial position, either you have to record as accruals or prepayment. Accruals where the required contribution is greater than the cash paid, and prepayment where the cash paid is greater than the required contribution. Now question arises, how cash paid can be different from required contribution? For this, we will consider an example. An entity makes contribution to the pension fund of employees at a rate of 5% of gross salaries. For convenience, the entity pays $10,000 per month into the pension scheme, with any balance being paid in the first month of the following accounting year. The wages and salaries for the year 2000x6 are 2.7 million. So we are required to calculate the pension expense for 2000x6 and accruals or prepayment at the end of the year. So first, what should be recorded in the statement of profit and loss as expense? This is annual contribution. An annual contribution is 5% of salary, means 5% of 2.7 million. This 5% of 2.7 million would be 1,35,000. 2,700,000 multiplied by 5% give you 1,35,000. So it is the annual contribution which should be charged to profit and loss. So this is the amount to be charged to profit and loss. Now we need to consider what is the amount of cash paid, and then we need to compare the annual contribution with the cash paid in order to find accruals or prepayment to be recorded in statement of financial position. So the cash paid figure is $10,000 per month, and if it is $10,000 per month and there are 12 months in a year, so the contribution paid by the company is 1,20,000. Here you can see that the annual contribution is greater than the cash paid figure, so the difference is recorded as accruals in the statement of financial position. As the company has to pay 1,35,000 as contribution, but during the year the company has paid 1,20,000. Now it is the liability of the company to pay further 15,000. Next is about defined benefit plan. This is a separate plan and it's established into which company makes regular payment. The obligation of the company is not fixed, as the company guarantees promised level of pension benefit to employee. Entity has to pay further to meet the promised level of pension obligation. Here annual pension is the salary in the final year into the number of years of service divided by 60. While the risk is for the employer, as the employer has to contribute some more amount. Measurement case, the measurement of net defined benefit plan involved recognition of plan asset and plan obligation. Plan assets are recognized at fair value and plan obligation is discounted to present value. Next is about format. Before discussing the format, we need to consider what is meant by net deficit. It means if the present value of obligation is greater than the fair value of plan asset, this situation is said to be net deficit, and the contrary is considered as net benefit. So if you start your format with net deficit, then you need to adjust net interest component, then service cost component, then contribution paid by the employer into the pension scheme, and benefit paid by the pension scheme to the retired employees, and the remeasurement component is the balancing figure, as we need to consider what amount would be recorded as a result of adjusting these all adjustment like net interest, service cost, contribution paid and benefit paid, and what is the closing deficit. The difference of these two amounts is recorded as remeasurement component. So first we will discuss each and every component. First it is about net interest component. It shows a change in net obligation or asset. If there is an interest on plan asset, it will be credited to profit and loss, and entry would be passed as debit plan asset and credit interest in case of interest on plan asset. And in case of interest on plan obligation, the entry would be debit interest and credit present value of defined obligation, and it will be charged to profit and loss account. Next is about service cost component. These are two components. First is said to be current service cost. Current service cost, it is said to be increase in obligation due to increase in employee service, and it will be recorded as debit current service cost and credit present value of obligation, and it will be also charged to profit and loss account. While past service cost is said to be change in present value of obligation due to plan amendment or plan curtailment. So if as a result of improved benefit as a result of plan amendment, the entry would be recorded as debit profit and loss and credit present value of obligation. And in case the benefit is reduced, the entry would be contrary, means debit the present value of obligation and credit profit and loss. Here plan amendment means introduction or withdrawal or discontinue operation which causes the changes in the defined benefit plan, while the plan curtailment is said to be significant reduction of employees covered by plan by the entity. Settlement. These are the transactions that eliminate all further legal or constructive obligation, like an employee may leave the entity for a new job elsewhere and a payment is made from that pension plan to the pension plan operated by the new employer. In such case of settlement, there could be a gain which is said to be if the reduction in present value of obligation is greater than the fair value of plan asset, then there is a gain. So gain is a situation where the reduction in the present value of obligation is greater than the fair value of plan asset paid. Remember to record this as entry: debit the present value of obligation, credit the fair value of plan asset, credit cash, and the difference would be either credit or debit and should be recorded in profit and loss account. Now it is about contribution paid. The contribution paid has no effect on profit and loss. The entry to record the contribution paid is debit plan asset and credit cash. So it has no effect on profit and loss account. Then it is about benefit paid. It is the amount paid from the plan to the retired employees, and it will be recorded as debit present value of obligation, defined obligation, and credit plan asset. As it will affect the amounts equally, plan asset and present value of obligation, so in format we will not consider this amount. Now it is about remeasurement component. After accounting for the above, the net pension deficit will differ from the amount that has been calculated in accordance with the adjustments. Then the difference would be recorded as remeasurement component. The reason of difference would be as calculations are based on assumption. Whenever there is a changes in assumption from year to year, assumptions like life expectancy, number of year of service and actual return on plan assets could be different from expected return. So we will now consider with the help of example, but before that, what would be recorded in statement of profit and loss? It is the interest and the service cost that would be recorded in statement of profit and loss or profit and loss account, and the remeasurement component would be recorded in other comprehensive income. While in the statement of financial position, we need to compare the present value of obligation and fair value of plan asset, and if the plan asset is greater than plan obligation, then it would be recorded as plan surplus, otherwise it will be recorded as plan deficit. Define benefit plan according to this. In the statement of profit and loss, service cost component and net interest component would be recorded. In other comprehensive income, remeasurement component would be recorded, and in the statement of financial position, plan obligation and plan asset would be recorded. And you can record a net amount with regard to plan obligation and plan asset. Now with the help of example, the following information is provided in relation to a defined benefit plan. At 1st January 2004, the present value of obligation is 140 million, while the fair value of plan asset is 80 million. It means the plan obligation is greater than the plan asset, fair value of plan asset, so it is a net deficit situation. And further information, in 2000X4, the discount rate or interest rate is given as 4%, current and past service cost is given as 30, benefit paid 20, contribution into plan 25, while the present value of obligation at 31st December is 200 and fair value of plan asset at 31st December is 120. So we can say that again at the end of the year there is a deficit of 80 million. At start it is a deficit of 60 million, at end it is a deficit of 80 million. You are required to determine the net plan obligation or asset at 31st December X4 and X5 and the amount to be taken to profit and loss and other comprehensive income for both financial years. So first we need to consider about the net deficit at start, at end. At 1st January 2000 X4, net obligation is 140, present value of obligation in fact of obligation is 140 and the fair value of plan asset is 80. So this is a net deficit of 60 million, while on 31st December 2000 X4 this would be present value of obligation is given as 200 million, while the fair value of plan asset is given as 120. So it is again a net deficit of 80 million. Now we need to consider, we will start from net deficit in 2004 and this is 60 million. Then we need to adjust the net interest component, which is 4%. 4% of 60 million would be net interest component would be 4% of 60 million and that would be 2.4 million. Then current service cost, current service cost is given as 30 million, while the benefit paid is 20 and contribution paid is 25. So current service cost 30 million, contribution paid 25, and benefit paid is not adjusted here because it has the same effect on plan asset and plan obligation. So next we need to consider what is the net deficit at the end of the year, and that is 80 million. So in accordance with our calculation, there is a net obligation of 60 million plus interest cost on obligation is 2.4 million, current service cost is 30 million, so obligation would be 92.4. But as a result of contribution paid, the liability has reduced to 67.4. In accordance with our calculation, the closing deficit should be 67.4 million, but it is in fact 80 million. So there is an increase in closing net deficit by 12.6 million, and this is known to be remeasurement component. Same is the case that should be applied for the 2000X5 year. Here the opening plan obligation is 80 million. Interest cost is again 3% of this, and that would be again 2.4 million. The current service cost is 32 while the contribution paid is 30. Current service cost is 32 while the contribution paid is 30. No adjustment for benefit paid, and the closing obligation for 2000X5 year would be difference of 230 of present value of obligation and fair value of plan asset. Again, the present value of obligation is greater than fair value of plan asset, so it is a net deficit of 90. So closing deficit of 2005 year is 90 million. In accordance with our calculation, this is a deficit of 80 million. As a result of interest cost, it would be increased to 82.4. Current service cost again increase the obligation to 80 plus 2.4 plus 32, and as a result of contribution paid that of 30 million, this obligation reduced to 84.4 million. But instead of 84.4 million, our closing net deficit is 90 million. Again, there is a remeasurement component of 5.6 million. Now we need to consider what amount will be recorded in statement of profit and loss. It is for the year 2000X4, 30 million of service cost and 2.4 million of interest cost. That would be recorded in statement of profit and loss. And other comprehensive income, the amount of remeasurement component of 12.6 would be recorded. While in statement of financial position at 31st December 2000X4, a net deficit of 80 million would be recorded. In case of 2005, the amount to be recorded in statement of profit and loss would be the sum of service cost 32 million plus interest cost of 2.4 million, and that would be 34.4 million. While in other comprehensive income, the remeasurement component of 5.6 million would be recorded. And again, in statement of financial position, amount of net deficit would be recorded.